Welcome back. In this next presentation, we are going to talk about the cost of equity. In our previous discussion of capital structure in a perfect capital market, we came up with an equation for the cost of equity. That equation said that the cost of equity is equal to the cost of equity of a firm without debt plus a premium associated with bearing financial risk. And that premium was the cost of equity of a firm without debt minus the cost of debt times the debt to equity ratio. There was a beta version of that equation, and the beta version of that equation is the equation you would end up with if you decided that you like to invoke the capital asset pricing model. Now, you didn't have to, and it doesn't actually save you any time or computational steps in this instance, but you could say equity beta equals asset beta plus asset beta minus debt beta times the debt to equity ratio. Then you could use that equity beta computation in the capital asset pricing model to come up with the cost of equity. Now, I'm not recommending that to you, but some people like to talk in terms of beta estimates, so that's an equation for you. Let's come up with the corresponding equation for the situation we have right now, in which there is one market imperfection. And that one market imperfection is the tax deduction for interest payments. Here is our equation. This equation says that the cost of equity of a firm with debt, we could also call that the levered cost of equity. That's another label sometimes textbooks like to use. The levered cost of equity is the cost of equity of a firm without debt. And I call that the expected return on assets, or RA in the previous analysis. Some textbooks like to call that the unlevered cost of equity. So RA could also be written as RE unlevered. So we've got the cost of equity of a firm without debt equals cost of equity of a firm, we've got the cost of equity of a firm with debt, cost of equity for the levered firm, is the cost of equity of a firm without debt, also called the expected return on assets or the unlevered cost of equity, plus this premium, cost of equity of a firm without debt minus the cost of debt or the expected return on assets minus RD times the debt to equity ratio times 1 minus tax rate. Now, this equation looks the same as we had before, but there's this other part of it, 1 minus the tax rate in there, and that changes things just a little bit. And I'm going to explain that over the next 10 minutes. The specific equations that only work if you're going to use the capital asset pricing model, this is the beta version of those equations. And it says equity beta equals asset beta plus asset beta minus debt beta times the debt to equity ratio times 1 minus the tax rate. So it's the same as the beta version that we had before, but there's just that 1 minus tax rate factor that appears right at the end. Now, there's something very important to understand about these two equations. These equations only hold under one very important assumption. They only hold if the dollars of debt are assumed to remain constant in perpetuity. Remember that our assumption in the prior example was that CVS was going to borrow $20 million and it was going to maintain $20 billion of debt forever and just make interest payments. That's what I mean by the constant dollar borrowing assumption. The dollars of debt don't change from one year to the next. And the equations that you see on the slide here correspond to the assumption that there's a constant dollar amount of debt. It was that constant dollar amount of debt assumption which also flowed through to my argument that a fair discount rate for the borrowing project was the cost of debt itself. Because in this world where we're just borrowing a constant amount of debt forever, it's a reasonable argument to say that whether we receive an interest tax deduction has the same risk as to whether we have enough cash to make interest payments themselves. So we set a fair discount rate for coming up with the present value of the tax deduction is equal to the cost of debt itself. Now let me just pause for a minute here, because this sounds a bit like I'm talking about something very esoteric and theoretical, not practical. But it's actually not something very esoteric and impractical. It's important that you understand some of these assumptions and the corresponding equations, because this is a big source of computational error in corporate finance practice. Let me show you something which I see all the time, and it leads to fundamental valuation errors. This equation you see on the left-hand side, this equation holds under the assumption that the dollars amount of debt remains constant. There is another equation we're going to look at in which we invoke the assumption that the percentage of debt remains constant forever. That is, for example, 20% debt to 80% equity, for example. And in our weighted average cost of capital computation, we typically invoke a constant percentage debt assumption. Not always, but that's very often the case, and lots of investment bankers adopt that assumption when coming up with the cost of capital. So it's important that you have the same view on leverage to come up with your estimate of the cost of equity as you use in your discount rate for valuation. If you make different assumptions regarding how much leverage the firm has for the discount rate versus how much leverage the firm has when you're doing your present value computations, that's going to lead to a source of error, and the errors can be really large. And it comes about just because there's a mathematical mistake. You don't want to make errors and unravel all of your good work in understanding profit margins and growth rates and the basic business model. These are the fundamental aspects of valuing a business. You've got to understand, is there consumer demand for the product? Is there competition? Do we have the supply chain? Have we got the right marketing strategy? These are the important business model aspects of making an investment decision. Now we take all those business model aspects and we run it through a machine, often a spreadsheet as our machine, and we say, well, given all of that business case, here's our valuation. Imagine at that very last step that you construct a valuation error of 20% simply because of a mathematical computation, a mathematical mistake, and you don't want to do this. And here's one of the big ones. Lots of investment bankers like to talk about beta. I don't know why they love it so much, but they do. They absolutely love it, despite the fact that the capital asset pricing model is biased, imprecise, and incomplete. But they love beta. They know it's imprecise. They know it's incomplete. They don't properly understand the imprecision, but they know that it's flawed, but they like using it anyway. And so bankers will typically involve the following assumption. It's very common on websites and in corporate presentations. They will say equity beta equals asset beta multiplied by 1 plus the debt to equity ratio times 1 minus the corporate tax rate. They'll typically use that assumption. Now the corresponding equation that we will use for equity beta, and there's going to be 2 of them that matches onto that equation, is as follows. We are going to make the assumption that if the dollars amount of debt remains constant, as we have here, we're going to say equity beta equals asset beta multiplied by 1 plus the debt to equity ratio times 1 minus the corporate tax rate minus the debt beta times debt to equity times 1 minus the corporate tax rate. Now in our assumption, this equation down the bottom here holds if the dollars of debt remains constant. So for example, if CVS took on $20 billion of debt and held it constant forever. We're going to see later that if the leverage in percentage terms remains constant, for example 20% leverage forever or 30% leverage forever, the equation will go back to what we had before. It will be equity beta equals asset beta times 1 plus the debt to equity ratio minus the debt beta times the debt to equity ratio. So that equation holds if the leverage remains constant year after year in percentage terms. This equation that the bankers typically use holds under the following two assumptions. The dollars of debt remains constant and the cost of debt is equal to the risk-free rate of interest. And that causes a problem because the investment bankers everywhere else in their model will typically assume that the cost of debt is above the risk-free rate. That's normal. Corporate borrowing costs are above government bond yields. And everywhere else in their model, they'll typically assume that the percentage of debt remains constant year after year. They'll typically assume, well, in my weighted average cost of capital, I'm going to have 80% equity finance and 20% debt finance, for example. So when they're coming up with their beta estimate, flying through to their cost of equity, they are making a fundamentally different assumption about the cost of debt and the leverage in the business compared to what's going on in their discount rate. And that fundamentally different assumption leads to misestimation of their cost of equity, and that leads to big valuation errors. That equation that the bankers are using on the slide, it was published in a research paper 40 years ago in 1980. For that particular research paper, it met the researchers' purpose. For the purpose of that research paper, there was a simplifying assumption made, or two assumptions, and they were the ones that I've just described. The researchers said, for the purpose of my financial modelling, for my simplified world, to keep things moving, I'm going to assume that the dollars of debt for my theoretical firm remain constant and the cost of debt is equal to the risk-free rate of interest, and came up with the equation that you see on the slide. Practitioners then took that equation and said, terrific, here's an equation for equity beta that relates it to the asset beta, and they ran with it. And they've used it in many applications ever since. But you don't have to use it. You can use the correct equation and therefore mitigate the risk of a valuation error. Moving on, let's see if we can verify the shareholders' return with our CVS example. So if I move on, recall what we did in our earlier presentation for CVS. We said, I'm going to show you an equation for the cost of equity for CVS in a perfect capital market, but with some leverage. And I did a computation of what we would expect to observe, and then I did a computation of the value of shares in CVS at time 0, and then 1 year later at time 1, and we checked whether the total return to the shareholders comprised of dividends and capital gains actually matched the equation that we've computed. So in this case, let's see what the total return to shareholders is in CVS once you put debt into the business. So recall that if we value CVS with no debt at time 0 and then 1 year later, so just roll the valuation forward, just like we did many examples with corporate bonds, enterprise value goes from $114 to $118 billion over a year. There's no debt, so equity value also goes from $114 to $118 billion. In our corporate taxes example, the dividend is $7.5 billion because there had to be a chunk taken out to pay taxes. The dividend yield was $7.5 billion on the starting equity value of $114 billion. So the dividend yield is 6.55%. The capital gains is the percentage change in the equity value over a year. That's 3.45%. And the total return, the sum of the dividend yield and the capital gains, is 10%. Well, that's what we anticipate. That was our cost of equity for the unlevered business, also called the expected return on assets, also called the cost of equity for a firm without debt, the unlevered cost of equity. Now let's put debt into the business. Let's value it twice, today and in a year's time. Today the shares are worth $98.3 billion, enterprise value of $118.3 billion. Recall that's $4.2 billion more than the value of the firm without debt because we got those tax benefits from borrowing. In a year's time, the enterprise value is worth $122.2 billion. I've just repeated the present value computations but moved them a year later in time. I've just grabbed the cash flows from years 2 onwards instead of year 1 onwards. The debt is constant at $20 billion per year, means equity value in 1 year's time is $102.2 billion. The dividend's less than we had before because now we've got the interest payments. So in dollar terms, the dividend is lower, but in percentage terms, the dividend is higher, dividend yield, because of the lower equity base. The dividend yield for CVS with debt is 6.8%. The change in the equity value is 4.01%. That's our capital gains. And so the total return, if all the cash flows turn out as we anticipated, would be 10.8% for the shareholders. So you can see that the total return to the shareholders in this world without debt and then with debt has gone from 10% to 10.8%. Well, what did our equation say should be the total shareholders' return once you put debt in the capital structure? Our equation says that the cost of equity is equal to the expected return on assets plus the expected return on assets minus the cost of debt times the debt to equity ratio. Well, if you put our cost of equity for the unlevered firm, or the expected return on assets, to 10% of the equation, a cost of debt is 5%, and $20 billion of debt on $98.3 billion of equity, and multiply that by 1 minus the corporate tax rate, you end up here with a 10.8% return to the shareholders. So, according to our equation, we expect shareholders to earn a return of 10.8% a year. If we go directly to the cash flows and do our present value computations at time 0 and time 1 and work out the return to shareholders, if all the cash flows turn out as we anticipate, the shareholders will indeed earn a return of 10.8%. So the returns are exactly what we would anticipate given our equation for the cost of equity. If you use some different equation, like this investment banker's equation, they won't line up because it's a computational error. The corresponding equation for the bankers, written in terms of returns instead of beta, the corresponding equation that the bankers would often want to use is that the cost of equity is the expected return on assets multiplied by 1 plus the debt to equity ratio divided by 1 minus the tax rate. And that equation doesn't work. Why doesn't it work? Because it assumes that the cost of debt is equal to the risk-free rate of interest, and that equation, that assumption doesn't hold in our computations here. The cost of debt was equal to 5%. It's not the same as the risk-free rate. So to summarise where we are with this one market imperfection, in terms of cost of equity as a function of leverage, pay particular note of 1 minus tax rate in equation 3. If you have no taxes, that was our perfect capital markets case, we have this equation here for the cost of equity, expected return on assets times expected return on assets minus the cost of debt times the debt to equity ratio. With corporate taxes, but with a dollar amount of debt remaining constant over time, like for example $1 billion, or in our CVS case $20 billion, the cost of equity is the expected return on assets plus the expected return on assets minus the cost of debt times the debt to equity ratio times 1 minus the corporate tax rate. So that's going to be our big change with a constant dollar amount of debt. But the final case we have to consider is what happens here. What happens if the percentage of debt remains constant over time? For example, 30% debt, 70% equity. And we're going to see that if the percentage of debt remains constant over time, we're going to end up with the same equation we had at the start. So even though the corporate taxes exist, we're going to end up with an equation that says the cost of equity is the expected return on assets plus expected return on assets minus cost of debt times the debt to equity ratio. And we're going to illustrate that in our following discussion.